money supply, and we're still just scraping the bottom in terms of gold and silver repricing. I mean, if we were to go to 100% gold standard, full coverage of all dollars outstanding with the 261.5 million ounces of gold that the U.S. holds, we'd have to have a gold price of $90,000. So 90,000 is a long ways from 4,000.
The big thing that's emboldened me to make the call I made recently is gold. I've just never seen this kind of rally. I look at S&P 500 is down 28% versus gold this year. Bitcoin's down, 20% versus gold this year. Well, that's just not the kind of thing. The last time these things happened was 2008, and Bitcoin didn't even exist. That's why I'm just very fearful, and I have to say what I think, because if I don't, it's disingenuous. I have to be able to help people when I see risks in markets.
The global economy stands at the edge of a monumental reset, a shift that could redefine what money truly means. Markets are distorted beyond recognition, with debt levels surging, valuations stretched, and asset prices propped up by central bank liquidity. Yet gold's rally tells a different story. For the first time in decades, the world's oldest form of money is quietly outperforming every primary asset class. The S&P 500 is down sharply against gold, Bitcoin is lagging, and the dollar's purchasing power continues to erode. This isn't a random market move. It's a repricing of trust itself. MikeMcGlone, senior strategist at Bloomberg Intelligence, and Lawrence Lepard, renowned fund manager and sound money advocate, both argue that we're entering the suddenly phase of fiat failure. What began as gradual currency debasement is accelerating into a revaluation of gold and silver against an ever-expanding money supply. With over $90,000 per ounce required for a full gold-backed US dollar, we are still in the early innings of this monetary repricing. Silver, historically the more volatile counterpart, could see multiples of its current price as the flight from paper assets intensifies. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think I disagree with Mike on sell gold and sell silver here. I think, and I understand from a trader's point of view, and it's way overbought, et cetera. It's moved, very rapidly for, this past year. And so, yes, there'll be volatility, no question. And could they both correct significantly? They could. But I take a more multi-year point of view on these things. And I think we're going to $150, $200, $250 silver and $10,000 gold. I'm with Dave. The denominator is just going to keep growing. And what I think the mistake a lot of people are making is that they don't realize that the market is changing, and we're kind of repricing what is money. And we're now we've gone from the gradually phase of fiat failing. I think we're kind of entering the suddenly phase. And that's based on what I observe in the acceleration of the gold price, and the silver price as well. And so, it depends on how you want to look at it. There are a lot of charts. In fact, there's going to be a lot of this. I'm writing my Q3 letter for my fund, which is free. It's on my website. It'll be out in about a week, less than a week, probably 4 days. And I've got all these ratios of the amount of gold and silver compared to the amount of the money supply. And we're still just scraping the bottom in terms of gold and silver repricing. I mean, if we were to go to 100% gold standard, full coverage of all dollars outstanding with the 261.5 million ounces of gold that the U.S. holds, we'd have to have a gold price of $90,000. So 90,000 is a long ways from 4,000. So I'm not suggesting we're going to go to 100% coverage. Generally, 20 to 40% gets it done. But my point is that, I think we're in the third or fourth inning of a very significant gold repricing in fiat terms. And that's primarily because the government is completely and totally irresponsible. And, if that were to change, I would have to revise my views quickly. But I still don't see any evidence that that's changing. I mean, the big beautiful bill, and yes, tariffs brought in some more income, but the big beautiful bill ate all that up, but it's all held together by the increasing stock market. So to me, what's going to happen in the gold and silver markets is kind of a pretty easy call, kind of a no-brainer almost. They're going to go higher over the next several years, undoubtedly, and then I think Bitcoin's going to do even better still. The chart that Mike showed, where the Bitcoin being right up against the increasing trend line, Bitcoin to gold. I think right now the easier trade is to buy Bitcoin than to buy gold. Gold's had a nice run. Bitcoin has lagged to that. Bitcoin will follow, in my opinion, and it'll follow with a vengeance. I mean, I think we'll be at 150 by year end and 250 sometime next year. So, I'm quite bullish on both of these, both of these assets as against fiat.
Remember what's happening. I wanted to show you one chart of guilty as charged of trying to find peaks and bubbles, and that's what I want to point out, because we did speak out the 87 crash. Here I show you this is S&P 500 divided by GDP in trillions. Just knock and divide by take and make it take the trillions down to 100, so it's like 30 trillion right now. The peak right before the 87 crash was below 1-to-1. It was like 0.7. That held for 7 years. Okay, stock market cap to GDP. And this is my point now. It's you just look at pattern recognition. Here we are at the highest ever. Now it shows 2.1 because it's S&P 500 versus GDP. The actual stock market cap to GDP is 2.3. But I use this metric because I can go back 100 years. This defensible data on the terminal. Number one thing in life is defensible data. This pattern I see here would got volatility down really low, and this most and I would say entitled president ever is very scary. So what's going to happen, I just don't know from where, is we're going to go down maybe to this level, have a 50% correction, my call, and it's just a question of what sparks it. And so my thought was, beginning the year was, okay, still have the same view, it's overweight gold and bonds. Now the gold has done great. Shorting the market's a hard part. I did a lot of that in 2008, shorted the market, and you caught part of this, but you had to deal with this first. That's the key point. Is right now we are so elevated. The only thing that matters, retail sales, everything, is the stock market. It's the greatest wealth effect in history. And I do appreciate the thing is part of that wealth effect is cryptos. There's so many 30-somethings who've made a lot of money. Some of them traded too much. It was the wrong thing to do, just buying and holding. At some point, you're supposed to say thank you and sell a good portion of that. Now, my rule when I traded, when I doubled, I'd sell half and then put the rest away. And that was a good problem because I love getting pissed off when things kept going up. But this is the point now. We're due for a reversion here. It's just a question what sparks it. And that's why I pointed out volatility so low. These kind of things, I look for the signals. It's the time of year. You're supposed to just sell rally. So my call for just sell everything, it was not a day trade. Yeah, it's nice it happened the day before, one little drop, but it's that S&P 500 total return on the year right now is 14%, yet bonds are catching up. I'm thinking maybe by the end of the year it might be 5 or actually down on the year. Now, if it's up, cryptos will be fine. If it's down, cryptos will lead the way. So Bitcoin will just fall on the back of all these millions of things that are just numbers on a screen. I just want to point out the current situation in China is the big print. Their money supply running around 45 trillion by some measure, but on a terminal. I chat GBT'd it and said more than that. It's double the U.S. Their debt to GDP according to Goldman Sachs is running 300%. Yet PPI in China is minus about 3%, and the 10-year yield is 1.85%. That's turning Japanese. Those of us who remember trading JGBs 30 years ago, it did the same thing, and Japan's still finally coming out of it. They did the big print. It took them years to get out of that inflation, but it was because risk assets went down too much, housing and the stock market. It's when you get the bubble that bursts, you can print as much as you want. You're still going to have those problems, and that's my point, is why I'm so concerned about cryptos and Bitcoin, is because they're risk-on assets on the back of the stock market. If you get that normal drawdown, which we haven't, at least 20% and stay down for a while, you'll have the flush. You purge all the excesses. It'll be a great buying opportunity. But that's my point, is the big thing that's emboldened me to make the call I made recently is gold. I've just never seen this kind of rally. I look at S&P 500 is down 28% versus gold this year. Bitcoin's down 20% versus gold this year. Well, that's just not the kind of thing. The last time these things happened was 2008, and Bitcoin didn't even exist. That's why I'm just very fearful, and I have to say what I think, because if I don't, it's disingenuous. I have to be able to help people when I see risks in markets.
That's a good point, Mike. And I think the risk of, when you've got a debt bubble that's as big as the debt bubble we've got, when it bursts, that's enormously deflationary. And 29-30 showed you that. And you're right, they printed money back then and it didn't solve anything. And the price of gold actually didn't go up much during the 30s, but the purchasing power of gold went up 10x because the price of everything else fell massively. So, if we get into, one of the cases that I often consider is what happens if we have a deflationary bust and they print like crazy and the prices of gold and silver and everything go up a ton.
Tightness in the silver market is beginning to expose the fragility of the global paper-based financial system. Reports from London suggest that major bullion traders are scrambling to secure physical silver as lease rates spike and liquidity dries up. Moving tens of millions of ounces from New York to London is no small task. It's costly, heavy, and a sign that demand for real metal is far outpacing available supply. This isn't just another squeeze, it's a reflection of a deeper structural problem. The system built on paper promises is starting to collide with physical reality. Gold and silver are revealing the underlying weakness of overvalued markets and debt-fueled economies. While central banks continue to print, investors are waking up to the importance of holding tangible, non-counterparty assets. Volatility remains suppressed, but history shows that such calm rarely lasts. When this fragile balance snaps, it will expose the illusion of paper wealth and highlight why precious metals remain the most valid form of money. Let's get back to the interview.
Bloomberg had a story, Mike, I'm sure you saw it, where they said that there's a squeeze going on in silver in London.
Yeah.
And people were checking out how to ship 15 to 30 million ounces from the New York COMEX stocks to the London stocks because, lease rates, et cetera, are very, very tight. And, this is kind of, in my view, this is kind of the paper markets, the paper silver market, like the paper gold market. People are saying, okay, give me the metal, right? And silver is one of those things. I mean, it's easy to move $1 billion of gold, or not easy, but it's doable, a couple $100 million of gold. Silver is goddamn heavy relative to its weight. And to put, 15 or 30 million ounces on airplanes is going to cost a lot of money. And so I think, it's on my Twitter feed. I think it's an interesting story to me that, and you're right, Mike, in the past, when these become front page news, you're near a peak. I think in this particular case, it's slightly different in that these metals are both very, very undervalued relative to, total fiat money outstanding that competes for them out there. And so I personally believe we've got quite a ways to run, which is not to say there won't be pullbacks all along the way, but bull markets try and throw off all the riders. But as for me, I'm going to continue riding the silver and gold bull because I think we've got, years of upward movement here. So to me, the bigger, what all this means, it's a bigger issue, is just how fragile is this whole system that, a tweet by the president, and now he's claiming that he just misunderstood what, which is kind of ridiculous.
The market went down. I was wrong.
Yeah, and the market, just gets absolutely shellacked. I mean, I don't know, it doesn't strike me. But there are no signs of a healthy market here. I mean, I'm with Mike in that this is a very overvalued, very fragile market. And while it looks good to the casual observer, I think there's actually a great deal of risk in this market right now.
The key question now as we enter the beginning of 4Q, is this the beginning? Is this the end of just a little bit of liquidation, or is this the beginning? Obviously, my bias, it's the beginning. I'd like to show a few charts why. So first of all, Trump made those comments, but we know the number one thing that emboldens this president is the stock market, and that was proven by his 90-day delay back in April on the tariff. So what I show you here, this is 90-day volatility on the S&P 500, and it just bottomed from the lowest level in 5 years. Wow. And the same chart is the 200-day moving average of the VIX. Those of us are technicians call that's a bull flag. It went up, it's staying there. Now the VIX is above that level right now, 19.3. So this is just little normalization. You get that 90-day volatility towards the same levels of VIX, which is about its average. VIX is usually trades at a premium. That's going to happen. It's just a question of when. I think it's happening now and sooner, and I'll point out some of the key things that really trigger me. Here's gold in terms of Bitcoin, the gold ounces. It's broken below this key support that's held since the bottom 2022. Now I show a weekly chart and also show the S&P 500 in terms of ounces of gold. It's breaking down. Looks like it's going to break below that low from 2020 at 1.5. And again, there's a good reason. Volatility is so low. When volatility gets this low, he just needs a little trigger. And Trump saying anything can be the trigger. So here's a key leading indicator, strategy. Those of us who invested in this thing in the past, it's broken down. Strategy is below its 200-day moving average. It's showing resistance and breaking down at the same time. Dave mentioned earlier T-bond prices. Again, this is where I started in the trading pits. What I know the most, I thought had bottomed back here. It's just starting to show life to start rallying. That's deflationary forces as we get the deflation from cryptos. And I want to show you one thing that I've been wrong on for quite a while. I'm just showing you this is the total return of the S&P 500 this year. Peaked up around 17. It's heading lower as volatility is bottoming. Now it's around 12%. And this is the total return of TLT, the most widely traded long bond contract in the world. I've been completely wrong in this. I think they're going to cross paths and TLT is going to outperform the stock market this year. And one key reason is because volatility is just so low. There's so much speculative excesses, and cryptos are the leading top of that whole thing. And this is where I just look at this little chart from MicroStrategy. If it's going down, it's just a signal the whole space is just due for some mean reversion. What we saw this weekend is what you typically expect. So what do we do going forward? And that's why I think you're supposed to be looking to sell rallies in all risk assets. Even gold is pretty expensive at $4,000 an ounce, and silver above 50. It's not a place you want to go out and buy. Lessons have been taught by buying silver above 50. Sure, maybe it goes to 55, but you don't want to buy into when you have short covering or squeezes like this. This is when you're supposed to say thank you very much. And here's what I like to end with: is it's really hard picking bubbles, shorting in the bubbles, using derivatives. Now I did that well in 2008, but because I had a rough year in 2007. What's been easy this year is being long gold, but now that's expensive. So what's the next big trade? And that's why I just look at that volatility. This volatility continues to just recover a little bit from a 5-year low. That's an awesome trade, but for buy and hold people, it's going to be tough.
Doesn't seem crazy to me. I still think gold's hit 5,000. I've been saying that for a while. I mean, yeah, pullbacks will happen, getting ahead of itself. Silver, the gold silver ratio could go to 50 easily. It's 15 in the Earth's crust. The reason for the gold outperformance, where 80 has been support, is because gold has been a monetary asset and central banks have been buying it, right? At some point, that starts to, kind of fade as Bitcoin gets into the picture, but it's not going to be now. It won't be this year. But could the gold silver ratio go down to 60 or 70 before it goes back up? Yeah, it could. It could. I mean, honestly, it will be probably under 20 in my lifetime if I stay in good health. Certainly in my son's lifetime, it should be that way, because that's where it should be. And those are the sorts of relationships that are very long standing. But since we've had the gold backed money era, that's when the gold silver ratio has been between 80 and 100. And so those are a lot of cross currents, Scott. And, if you're trying to trade this market, I mean, look, we just saw a candle in Bitcoin. It just jumped, $1,000, which is nothing really. I mean, it looks big on the chart, but it really is nothing compared to what we are. The question really is, with all of these assets, is where's the value? And I will be happiest and say this rally that is likely to happen is more likely if the things that rally are the things that people really do want to buy and less degenny of assets. So I think the Bitcoin fart coin ratio is really important, right? And I love to see that. I mean, you laugh, but I think it's a big deal, right? I think it really matters, and I think that's the sort of thing. But remember, money is being printed consistently in every major economy around the world. And so that's something that we have to understand. As far as interest rates are concerned,
the quiet tremors in the silver market are now echoing across the broader financial system. Behind the headlines, real metal is vanishing from vaults, while demand continues to surge from both institutional and private buyers. This isn't speculation. It's confirmation that the world is waking up to the limits of paper promises. As confidence erodes and physical supply tightens, gold and silver are beginning to reclaim their historic roles as anchors of real value in a sea of fiat instability. The illusion of a strong economy fades quickly when measured against the accelerating debasement of currency. Every new wave of money printing, every expansion of credit, only strengthens the case for hard assets. The next phase of this cycle will not reward risk, but resilience, and precious metals remain the ultimate refuge for that. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.